Welcome back to an episode of Sick Investing with Arya, and I don't waste your time, so let's get straight into it. Ladies and gentlemen, in today's video, we're looking at a software monopoly soon to be disrupted, AI's eating at their moat, increased competition. We'll get into all that, but the stock is down a massive amount in a very short period of time over the past, call it, month and a half. And in fact, if we just simply toggle on the drawdowns feature, we could see that they're in one of their worst drawdowns in the past however long. I think we zoomed out pretty far here. Yeah, so we're looking at roughly the past decade, and you can see other than the crazy 2022 drawdown that we had, this is by far the worst drawdown that this business has had over the past roughly 10 years. And so naturally, when a stock makes such violent moves to the downside, it's not for any random reason. In fact, there's a pretty decent reason. And mainly, this all started in roughly mid-December when Adobe reported earnings, and the stock on the day of the earnings dropped 12%, and in the next 7 days, they dropped a total of 21%. The reason being they had a lower than expected revenue guidance. And then on top of that, it seems that their AI investments might end up taking longer to see a return on it. And so we have a quote from an analyst here that they say, while the company remains on track with its Gen AI product roadmap, we think that the lack of explicit monetization metrics has made it harder for investors to get comfortable with the progress, which totally makes sense. In the past, give or take 2 years or so, we've consistently seen this theme of question marks around AI monetization for various different software companies, tech companies, all that type of stuff. And then later on, they eventually figure it out. It takes them a couple additional quarters, that type of stuff. So that alone wouldn't worry me too much. The slowdown in revenue, we also saw that with Salesforce earlier in the year. It was a couple percent slowdown at the end of the day. It ended up not being too big of a deal. So far, doesn't seem like this is a existential crisis to this company. And so naturally, if we're not worried about the small fundamental deterioration, what is the big worry for this business? It would have to be all the tiny little startups that are essentially trying to disrupt them, right? So you have all these companies such as Stability, Midjourney. I'm sure many of you guys have heard of that one. OpenAI has their Sora. I believe Google has their version of like a creative software and that type of stuff, right? So all these tiny little companies, of course, some of them are like pretty well capitalized, such as being backed by Microsoft and Google and that type of stuff. And essentially, they're moving faster and they're creating results before Adobe does anything. Or if Adobe is also creating all these AI-generated softwares and stuff, it's not as good. So this naturally is kind of, I think, putting some fear into the investors, and rightfully so. Of course, this is technology at the end of the day that is very rapidly growing and very rapidly changing. So we could see sentiment change and technology change in of itself very quickly. I mean, just in the past year, how many times has Google shifted from this is an AI story, they're going to be huge in AI, they're AI leader, whatever, to AI is going to disrupt 10 blue links, there's no monetization, right? So you could see that as the stock price moves, so does the sentiment around it. So I don't think the death to Adobe, if it were to happen, I don't think it's going to be like next quarter. I think it would definitely have to take a handful of years and you would see it coming from a mile away. And Adobe's not going to just stand by and die a slow death, right? They're going to compete. They're going to try to increase their investments into AI and try to make a competitive product. And I always say this, particularly around software, it's not who has the best product. It's always who has the good enough product, but has the distribution to sell it to as many clients as they can, right? So clear example of this would be the software giant in Microsoft. They don't necessarily have the best software. And let's just take a basic example. The Excels and PowerPoints and that type of stuff. It kind of clunky, outdated. It doesn't necessarily have a great user interface. And for note taking and stuff, something as simple as Notion does a better job than Microsoft Word, right? But the thing is, Notion is not that widely used because A, Microsoft has the brand, and B, they have the massive distribution. When they're selling to particularly enterprise and institutions and that type of stuff, the thing that they're solving for is that this is the best good enough package that we could sell to you. The exact same thing goes with Adobe, right? So when Adobe is selling to massive institutions and companies that require creative cloud softwares, those companies, when they're making a purchase decision for 100 employees, they're not necessarily looking at this Figma tool or this Canva tool or whatever, this is the best one. They're looking at Adobe is the standard. It's been used for 20 years. We know it's going to be consistent, reliable, and by far they could give us the cheapest price for the total package of Photoshop, the video editing, audio editing, and the 10 other niche little softwares that will also get kind of bundled up and included in there, right? And also there's a whole thing of This goes back to IBM actually, of you'll never lose your job going with IBM, right? This was a saying way back when, where it essentially said that like we know IBM's reliable and that type of stuff, and it's always like top of mind when you're looking at a service that IBM competes in, right? Similar thing could be said with various other companies and various other services that they provide. Of course, you have Microsoft with their Office 365, you have Adobe with their suite of software, so on and so forth, right? Salesforce with their CRM, like it's defined as the standard, everybody knows how to use it. And actually in many cases, these companies, what they've done, I know Adobe does this, Microsoft does this, Autodesk does this, so many other software companies, they give it to you for free in university and colleges, betting on the fact that like they're kind of expanding the moat and like ensuring that they are the standard even at like younger and younger stages. Of course, then you have like Google coming in at like elementary school level with like Google Classroom, Google Drive, that type of stuff, right? So anyways, as it stands currently, they're still the leader in creative software. The thing that you have to watch for is whether or not this company is going to experience a shift in their industry whereby the appetite of their customers just completely changes, right? So if we move from a world of like people on Photoshop, from scratch, they're making all these different images for advertising or whatever, to instead we have it AI generated and then we simply edit it afterwards and like tweak, I don't know, 10-15% of the image, good to go, we can ship that, right? So moving from generator to like editor almost. And if Adobe doesn't have a good enough generator, they're not going to be competitive. Right then and there, that is essentially instant death because you're not competitive in the new paradigm of where your industry is moving, right? So that is the number one thing I would have top of mind as an Adobe investor. But at the same time, that's nearly impossible to kind of predict, right? And also you got to be wary of like all these headlines of fact versus fiction and like how feasible is a change like that? How feasible is it that the technology is developed, you know, in the next couple of years and Adobe can't follow, right? That's another thing. You got to imagine Adobe with their $20 billion of revenue per year. I think they'll figure out to come up with some sort of product. And again, reminder to what I said earlier, it's not the best product that wins. It's the one with the most amount of distribution that has a good enough product that gets the job done. It's much easier as an executive of a company to go with Adobe, just add that package onto your current bundle of creative software, than it is to go to a whole new vendor and deal with them. And you've probably had decent experience with Adobe over the years. And I'm strictly talking enterprise here, right? So actually maybe another thing we should dive into is that on the consumer side, like the just random me and you that is using Adobe softwares, the switching costs on that is infinitely lower. But before we do that, I do want to go over to a video I made on Adobe a little while back. And in this part, actually, I was talking about Figma and Canva. If you haven't been following the story, Figma and Canva are two cloud-based, meaning they're on web browsers, essentially photo editors. I think Canva does video editing as well. They do a bunch of other stuff. It's not as polished, it's not as good, but mainly what they're used for is mostly free on the web creative software that are essentially counter-positioned against Adobe because Adobe is primarily installed on your computer. It's on-premise software compared to their web-based software, right? And actually in 2022, I believe, Adobe put out a massive $20 billion bid for Figma. Figma at the time was a $500 million revenue business, or it might have been even less. So you're paying 40 times revenue for a tiny little business compared to, again, Adobe's like $20 billion in revenue. What is going on? Do they really think it's that big of a threat? Spoilers, the deal fell through. And as a part of the deal falling through, they ended up paying them $1 billion as a breakup fee, which is just absolutely massive. I mean, with that $1 billion, that's like, you get it for free. Right away, you could go start hiring a billion engineers and you start speeding up your pipeline of developing Figma and making it a better and better product, right? Like that is just absolutely the biggest blow because essentially Adobe admitted this is a really big competitor. That's why we're willing to pay such a premium to get them. And then they turn around and end up paying them. They end up literally funding their business for multiple years for nothing, right? Like unbelievable. Anyways, I'll play you the clip and then we'll talk about it.
This is actually a similar situation to what happened with AT&T, I think roughly in the 2018 timeframe. They tried buying up a smaller competitor, and in the process, they actually ended up funding their business for a number of years, right? So again, this is a risk factor to consider that Figma is winning the hearts of graphic designers all over the world, and it's an incredibly fast-growing company. I think they're actually supposed to IPO in like 2025 or something like that. So again, something to consider. There is competition, and the competition is growing, and that's something to watch. But nonetheless, I think it's like the age-old Microsoft playbook, right? Like they just keep packaging on these softwares into and it's ultimately the best bundle that you could purchase as a professional working in the industry. So I don't know, very tough task cut out for Figma, but nonetheless, they're executing on all fronts as it stands currently. Definitely something to watch on a going forward basis.
Competition is definitely increasing within the digital, software, creative design, whatever you want to call it, industry. And it has been for the past handful of years, particularly from Figma and Canva. And I feel like a broken record here, but the point still stands. For most people, it is the best bundle of software to just go with Adobe, right? Now, it's not ideal that they're taking market share. They're both growing really fast while Adobe is seemingly falling behind, particularly with AI and that type of stuff. And so this brings me all the way back to the valuation of this business. By the way, this software you're looking at is finchat.io. As of a week ago, I'm officially an employee at the company. So I'm happy to announce I'm helping build the best stock research terminal in the world. Anyways, if we look at Adobe's valuation, and we can look at a couple different ones, but just to keep it classic and straightforward, I'm going to go to the ratios tab here, and then let's look at forward valuation. And just simply pull up we're looking at margins here, the forward valuation, and then just simply toggle on the forward PE of this business. And so what that does is it pulls up the past 10 years of Adobe's forward PE. And so very clearly we could just right away see that it's trading near the bottom of its forward PE range over the past 10 years, right? Of course, this doesn't necessarily mean anything on its own, because the business that Adobe has been for the past 10 years doesn't necessarily mean that that's going to be the same business on a going forward basis. And particularly, it might not have the same growth that it has had for the past decade. I think for the past decade, it's comfortably achieved mid to high teens growth. It likely won't have that in the coming decade, right? So it's being priced lower, and rightfully so. But I mean, the point still stands that it's trading at basically the bottom in terms of forward PE, right? And if you're a regular viewer of the channel, you know that I've been highly, highly critical of the PE. It's probably one of the most it is the most flawed, commonly referred to metric. It's kind of used as this standard of doing valuation. Meanwhile, depending on the company, and for most companies, it doesn't perfectly encapsulate just how cheap or how expensive a business actually is. But for Adobe, I think it's a more mature business. They don't have that many equity investments. So the PE is actually a pretty fine method of looking at the valuation, right? Now, another method of valuation that I've personally been recently using more and more frequently is EV to EBIT. EBIT is just operating income, by the way, for those of you who didn't know. And the reason I like EV to EBIT, well, enterprise value just takes into account how much cash and debt a business has. And then the reason I like operating income is because it doesn't take into consideration anything below the operating line. So all the funny business going on with equity investments and all that type of stuff, it doesn't capture any of that. And then if you particularly look at GAAP operating income, which this is GAAP operating income, it deducts stock-based compensation. So the issue with free cash flow always is that you have to take into consideration stock-based compensation. The issue with PE is that there's a bunch of equity stuff that you might not know is going on. Anyways, EV to EBIT also trading near the low it's ever traded at. And again, I'm going to toggle on the minimum line here to kind of get a picture. So the minimum over the past 10 years for Adobe was 15 times. They're currently trading at 16 times EV to EBIT, right? And then if we simply toggle on the average here, actually I'm going to do the median instead because I see we have some pretty big outliers up here. You could see that the median over the past 10 years was 26 times, right? So definitely, without a doubt, on the lower bound of its valuation. But again, we have to go back to, is this deserved? Is this a business that in the future is going to trade at very cheap multiples because of the increased competition? I think it's definitely a possibility, but I think it will take much longer than people anticipate. I think particularly on Twitter and that type of stuff, because of the 24-hour news cycle, it's very fun to kind of pick the top on a big business and say, oh, it's doom and gloom, it's going to zero, all that type of stuff. You see it time and time again with, Uber and Google and all that type of stuff. But I think even if these things were to materialize, it would take multiple years, and it would be very obvious coming from a mile away. But until I personally see material changes to the business and I see competitors reporting massive growth, quite literally hampering Adobe's revenues and free cash flows and all that type of stuff, I personally wouldn't get worried. Now, with that being said, am I going to invest in this company? Probably not. And so if we jump over to the dashboard feature on FinChat, which I spend, probably 50% of my time on this website, just strolling through here. This is my current portfolio as it stands today, January 12th, right? And I have a bunch of these so-called getting disrupted by AI companies. Namely, you have Uber, Google, and Salesforce. And I've actually been able to buy massive amounts of these stocks over the past year when they do trade down as a result of AI. particularly with Uber. Actually, all three of them. Yeah, I've been consistently buying them, right? And the reason I bought all three of them was because at the time that the stocks were trading down and it was doom and gloom, if you go on Twitter, Google's going to zero. Of course, 10 blue links. No way they're going to be able to monetize it in the new paradigm. Salesforce, SaaS is useless, right? All this stuff. At the time that these stocks were going down, and Uber is still admittedly like it's around the lows, right? I personally wasn't able to identify a future where these businesses wouldn't succeed in the new paradigm. Or if, like, I was fine with the risk versus reward of it, right? Of course, there's always a chance, but more often than not, I'm willing to bet that the world stays the same, things don't change, and again, goes all the way back to distribution. These companies are already humongous. They're going to distribute tiny little AI features, and customers have absolutely no reason to change to a new sort of unproven competitor just purely because the one that they have now works fine. But in the case of Adobe, the one part where I don't like about the thesis, I'm not worried about the AI stuff. I think that'll take a while. The one part where I really dislike it is perhaps a little bit, I'm personally biased because I use Canva very regularly. I use it in all of my thumbnails, and I use it personally in my life a little bit as well for my work sometimes, right? And so the part where I don't like it is like, I'm seeing it firsthand how I've just completely avoided Adobe all these years. And even with my video editor, I use DaVinci Resolve. I don't use Adobe, right? So, and both of those are free. Well, Canva could be paid, right? And I don't use Figma, but from people I trust, they've also, in the matter of like less than a month, they've switched from Photoshop to Figma, and they just do all their work there, right? Like the switching costs are just not there for me. And I think that Adobe's moat is in fact narrowing. I'd be fine if like the moat would just remain stable, but the fact that I'm seeing material damage to the moat in the business, again, not from the AI side of things, but from like two young, nimble competitors in Canva and Figma, that completely worries me. And I don't like that uncertainty. I don't want to buy into a business that is becoming smaller and losing market share. If you look across all my holdings, they're either maintaining or gaining market share or gaining dominance, right? That is personally what draws me back with it. With that being said, in the next, I don't know, short term, call it 6 to 18 months, will the stock do well? Yeah, there's probably a really good chance. It is so oversold. 20 PE is just absolutely ridiculous, right? I think there's a really good chance multiple expansion comes in and they end up doing well. It shoots up 30, 40, 50%, right? With that being said, look at it from my shoes. Let's say I believe that's going to happen, and what percentage of my portfolio do I make it if I'm going into it thinking, oh, this is a short-term holding, right? Because I do view it as a little bit risky. And like, okay, I put, 5% of the portfolio into it, goes up 50%, that's 2.5% growth to the portfolio. But then like in my portfolio right now, I have a company like Uber or even ASML, right? Where I think they're currently undervalued. I think in the next year even, and I'm fine if it doesn't happen. I'm just saying like based off stock price movements, astrology, technical analysis, all that fun stuff, right? I think in the next year or so, they could do pretty good. They could move tens of percents, again, in the next, call it 4 to 6 quarters-ish. And so if I'm thinking of opening a position in Adobe, I have to look at Adobe versus ASML versus Uber, and I have to look at like, okay, which one is the most sure bet? Again, it goes back to the risk versus reward thinking and bets. And like realistically, if I think they'll have similar return potential over the next however long, why wouldn't I just consolidate more into the more sure bets? I think Uber has a higher percentage chance of doing well in the future, and actually I would be more inclined to hold on to that business for multiple years. Adobe is essentially a swing trade. I would just be opening the position, and I don't want to own that business in the long term. I don't think it'll do well. The tides can change, the business could start doing better and innovating and all this stuff, right? The point is the trend is not in your favor at the moment with Adobe. They are literally losing market share. So it all just goes back to thinking in bets for me. And at the moment, aside from the fact that I have no cash, I'm not interested in Adobe. I think it is really cheap, and more power to you if you understand the business better and you're willing to open a position, however percent of your portfolio is going to be. But as it stands currently, I have better ideas with similar setups. Now, if you watch this whole video and you learned anything, I just need you for 30 seconds. The website, I work for FinChat now, and completely for free, without the need for any payments or any type of stuff, you could click the top link in the description. You'll get 2 weeks of the full functionality version of the website. All I ask you is just give it a try. We've been using it all video long, and there's a bunch of other tabs on the left over here that we didn't even explore in this video, particularly the charting tab. It is genuinely a brilliant software, and I can't wait for you to try it out and let me know what you think. Again, completely free, no strings attached. It's not a free trial. You just automatically get 2 weeks free. With that being said, thank you very much for watching and have a great day.